so much, Mr. TR Srinivasan, for joining us on ET Now. Let's begin by talking about some of the trends that you've witnessed so far post-unlocking. Has there been a meaningful pickup in demand in OEMs or the aftermarket?
Good morning, Aisha. Thanks for having me on your show. So post-lockdown, we resumed our production towards the end of May. And since then, the volumes have been picking up quite rapidly, actually faster than what we expected. So the demand from the OEMs have been fairly good and picked up quite well over the last few weeks. And the outlook also is quite promising. So overall, I would say the pickup has been faster than we expected, and it seems to be holding up at least for the next foreseeable in the short-term future. So things are looking better, but fingers crossed to hope that it will continue.
All right. Avan joining in on this side. Mr. Srinivasan, what is the update when it comes to your China joint venture, and how do you see demand trends playing out over there?
Actually, China went through the COVID-related crisis and lockdown earlier than the rest of the world. So that was more in the Q4 of the last financial year. And there also the recovery has been pretty fast. And actually, Q1 of the current financial year, the China overall automobile market actually has grown over the previous year, same quarter previous year, by about 5% in volume terms. And our revenues also have grown slightly ahead of that. So actually the China story is even stronger than the rest of the world, I would say. And our joint venture in China also has done quite well. The first quarter last year was just a kind of a break-even situation at PAT level. And this year, actually, we recorded profits of about 11 crores, our share of the profits. So China is, and the demand seems to be holding up quite well in Q2 as well. So the China is also quite encouraging.
Are you getting similar feelers from other global OEM clients as well? You know, in terms of which segments you see driving the pickup going forward?
Yeah, the pickup, across the region, we see the demand coming back, but it's a bit of a mixed bag between the regions. North America has been also been doing quite well, and in fact, the North America OEMs did not take the normal summer shutdown that they normally take for maintenance, etc. They have been running the factories continuously because there seems to be a lot of pent-up demand post-lockdown, which is coming up. Europe, compared to China and North America, has been a little subdued, but there also things are on the positive trajectory. So overall, it's encouraging, but obviously the visibility is somewhat limited because nobody is sure as to when there could be a second wave of COVID and related lockdowns, etc. Presuming there are no major disruptions because of that, we expect the rest of the year to go well, and hopefully the next financial year we can build on that momentum.
What about the domestic two-wheeler market as well? How's that looking in terms of momentum?
Yeah, so domestic two-wheeler market as well as the four-wheeler and three-wheeler, in Q1, the production volumes dropped quite significantly, between 75 to 80% compared to last year. So which is understandable given the almost 2-month kind of a shutdown we had. But since then, the demand pickup has been good. So we have been, the Western region based OEMs have been faster to ramp up and scale up the volumes. North and South have followed suit with a lag of maybe 3 to 4 weeks. And they're also now picking up quite well. So demand pickup is there. And actually in the month of July, our revenues were about 90% of July previous year. So that means we are coming back to a kind of a normal level pretty quickly. And the outlook for August and September, which are the key months because all the OEMs are ramping up production for the festival season, is also been quite good. So, and we are actually doing our best to keep up with the demand. And so what needs to be seen is how the demand holds up post the festival season. So the months, how the demand plays out in the month of November onwards will be key to see how much of this demand is pent-up stroke festival season related and how much is a sustainable long-term recovery. So that we will come to know only maybe 1 or 2 quarters down the road.
Sure. Mr. Srinivasan, the government's push towards an Atmanirbhar Bharat, does that challenge your joint venture and business with China in any which way?
Not at all, because the joint venture we have in China is a local for local operation. So we manufacture in China to supply to OEMs in China who also sell within China. So there is no dependency of our Chinese JV operation to our India business. So we don't import anything from our JV or anything like that. And actually we see this as an opportunity because of the Atmanirbhar initiative, which is actually very required for the Indian industry as a whole and the economy as a whole. A lot of OEMs are now making plans to find alternate vendors in India for the components that they are importing from China at the moment. And obviously, with our kind of wide product portfolio and very, let's say, large manufacturing footprint, we hope to be able to grab some of those opportunities and increase our revenue in the coming years. But it is not going to be a short-term impact because it takes time to approve new vendors, products, and do the development and start supply. So maybe it will play out over the next 1 to 2 years, I think.
Sure. I also want to talk about the global automotive lighting business, which clearly seems to be in a bit of a sweet spot right now because of the kind of increase that one has seen in lighting content per vehicle and the shift towards high-value LEDs, OLEDs from halogen as well. How is it that you plan to tap into this opportunity?
Oh, actually, we are at the leading edge of this, let's say, the transition. In terms of the kind of technologies that we have in our suite of products and that we are able to offer to our customers. Actually, we were the first supplier to Tesla when they launched their models, first models, Model S and Model X. And even today, we are the exclusive supplier of lamps to Tesla. And because of that, we have a lot of experience in electrical vehicle related lighting technology, which is mainly driven by LED kind of products, which are very energy efficient, which in turn helps to conserve the battery life. And because of that, our experience, other OEMs, when they are launching their EV products, also consider us as one of the first choices for supplying. And we have won a number of new programs with them as well for their EV product range. So that's really helping us drive our growth as well as penetration into other OEMs. So it's actually playing to our advantage right now. So.
And what's the new normal for Varroc in this post-COVID era when it comes to your margins for the next few quarters in light of the kind of cost rationalization steps that the company has taken? What can we assume will be your revised financial targets?
Okay. I can't give out specific numbers, but I can give some broad indications. Actually, we look at the COVID-related disruption as an opportunity in disguise or a blessing in disguise. It really helped us or forced us rather to take a close look at our cost structure, at the capacities we have available, as well as the investment plans we had over the next 2 to 3 years. And we have worked out a number of steps to optimize our fixed cost base. And we are targeting a reduction of about almost 20% in our fixed cost base, which will be realized starting from the second half of this year. A number of steps have already been implemented. We have also rolled back on our CAPEX plans because we have enough capacity set up to meet with the revised demand projection. So that will also optimize our capital employed and minimize our net debt borrowing position. And there are also a number of manufacturing efficiency related initiatives we have launched in our factories. So with all this playing out over the next 2 to 3 quarters, we definitely expect a good improvement in the overall margin profile as well as the, let's say, the ROC, ROE related parameters and also on the cash flow. The encouraging thing is in the month of July, at about 90% of revenues, we were already kind of slightly positive, both in terms of profitability and cash flow. And we hope to build on that momentum for the coming months and quarters. And our hope is to end the full year with more or less break-even or slightly positive PAT and also a small positive free cash flow. That's what we are targeting for the year. But again, it depends a lot on how the demand holds up in the coming quarters. So, but we are fingers crossed, but we are reasonably optimistic about that. So.
All right. Thank you so much for joining us and giving us a view as to what the future will look like for the company, as well as the cost rationalization steps and financial metrics. That's the word coming in from Varroc. By the way, the stock is on a tear.